Let's talk about the international picture with Michelle Gibley as we head towards the closing bell here. Director of International Research at Charles Schwab. Michelle, good to have you here this afternoon. Let's kind of start by putting the bow on this week. We did see some more solid data from China overnight. Seems like more progress on inflation from Europe. What are your big takeaways across the global stage this week?
Yeah, I think probably Chinese data and the plan to support the property market is probably the biggest news of the week. China's property sector actually continues to weaken. Sales fell 31% year over year, and prices fell more this month than last month. And, property is really important because it accounted for over 20% of China's economy before COVID. And now, so they have a new plan to buy unsold housing inventory and turn it into affordable homes. And they're reducing mortgage rates and down payment rates. And these are all steps in the right direction, but they really need to do more. And the funding source for this plan may need to be adjustment as well as the amount. So they're saying $42 billion to be provided to buy homes, and they may need more like 10 times that amount for it to really be a bazooka, similar to TARP that we saw here in the U.S. in 2008. Wow. Now, it could provide a liquidity for developers, and with the right policies, the property market could put in a bottom as soon as this year, but the recovery is likely to be long and drawn out.
So they're that deep in the hole still. We're like, this isn't even a bazooka.
This is a baby step.
Wow. What about the kind of industrial side with that production number? Is there a kind of a gap or a lag maybe between what kind of kicks off in industrial and sort of mechanically in the economy before maybe the consumer side kicks in?
Yeah, China has really focused on providing stimulus to supply, to add supply in terms of manufacturing or infrastructure, and they really haven't done anything to stimulate demand on the consumer side. And we're just continuing to see that in the economic data. We're showing this imbalance between manufacturing and consumer spending. The economy has stabilized, and it's likely to hit the 5% GDP growth target, but consumer sentiment is still weak. But, better or worse matters more than good or bad in terms of stocks. And Chinese stocks started the year with really low expectations and low valuations. Even still after this bull run that we've had, the MSCI China Index is still below the 20-year average PE, trading just 10 times earnings.
Wow. So even with the pretty big liftoff, 30% now just in the last 3 months, it seems like there's still a case to be made that if they're going to make progress in the economy, the stock prices are going to make more progress too. What about when we compare to Europe? Like, where does our incremental international dollar get the biggest bang for the buck right now, Michelle?
Well, I mean, China's stock market is definitely the cheapest. Europe is probably the next cheapest. And we've had some good news there. The recessions in both the Eurozone and the UK ended. Both economies bounced back more than expected in Q1, and inflation has moderated. And so the ECB and Bank of England could both start cutting rates this summer. Markets are pricing in a 95% chance the ECB starts in June before anyone else of the big major central banks. And also the earnings recession in Europe is expected to end with Q1 earnings. And so, European stocks are hitting all-time highs and could have further room to run. They're just trading 13 times earnings.
Wow. So when we look at the list of international trades, we got to finish with Japan, as it does seem like, it was like the month of Japan during April. It was like all anybody wanted to talk about. I don't know. It feels like, I guess, have we run out of surprises from that bag, Michelle? It's a pretty quiet couple weeks here.
Yeah, I mean, the Japanese economy is just kind of struggling right now. And we got GDP for Q1 this week. GDP fell more than expected, 2% in Q1. And inflation is also moderated. So these are kind of going in the opposite direction of what the Bank of Japan needs to start hiking rates. And so there's some disagreement about whether or not the Bank of Japan can start hiking again in July or if they have to wait till September. Regardless, the interest rate differential between Japanese and U.S. government bond yields is likely to stay wide, and that could continue to support the dollar relative to the yen. We probably saw some intervention earlier this month by the Ministry of Finance, and it's kind of helped, but it's hard to keep that going longer term.
Okay. Yeah. Seems like still a lot of work to be done there. But at least, we're seeing some steps in the right direction for a lot of these international economies that have been under such deep pressure. It's, really a kind of a game of relative strength and expectations. A lot of these numbers aren't impressive on the top line, but they're getting there. They're making progress. Thanks for putting it in perspective for us, as always, Michelle. Much appreciated.
Thank you.
Have a great weekend. Michelle Gibley, Director of International Research at Charles Schwab.